You've been doing this for more than 40 years. You've seen high-rate environments, low-rate environments, booms, recessions, housing shortages, housing surpluses. What have all those years taught you about people trying to perfectly time the housing market?
And the mortgage rate is important, but it's only one part of the transaction. Sometimes the better opportunity comes from looking at the entire deal.
Let me push back on you. Suppose I'm watching this and thinking, Jeff and Art, that all sounds great, but if rates drop by a full percentage point next year, I'm still better off waiting. Are they? What if waiting for mortgage rates to come down actually cost you more money? That sounds backwards, right? Rates are higher than most buyers would like, so the obvious move seems to be wait for rates to fall, then buy. But what if lower rates bring more buyers back into the market, more competition, fewer seller concessions, and higher home prices? Today, we're going to look at the housing market from a completely different angle. And to help us do that, I'm joined by someone who has spent more than 4 decades helping buyers and homeowners navigate changing mortgage markets. He's the owner of MortgageWorks, and if there's one thing Art Alvarez has seen before, it's a changing market. Art, welcome back to Mortgage Minute.
Thanks, Jeff. And I really like this topic because I think a lot of people are focused on just one number right now, the mortgage rate. And the mortgage rate is important, but it's only one part of the transaction. Sometimes the better opportunity comes from looking at the entire deal. The price of the home, seller motivation, concessions, financing strategies, and what the market looks like when you're actually ready to buy.
Okay, let me give you the argument we hear all the time. Someone says, Art, rates are still higher than I want. I'm just going to wait until they come down. On the surface, that sounds pretty reasonable. What's wrong with that thinking?
There may be absolutely nothing wrong with waiting. It depends on the buyer. But the mistake is assuming that when mortgage rates come down, everything else stays exactly the same. Housing markets don't work that way. If rates decline enough to make buyers feel more comfortable, some of the people currently sitting on the sidelines may come back into the market. Now you potentially have more buyers competing for the same properties. That can mean fewer seller concessions, stronger offers, and potentially more upward pressure on prices. So the question isn't simply, can I get a lower mortgage rate later? The question is, what will the entire transaction look like later compared with the opportunity I have today?
That's the part I think people overlook. Because here in the Coachella Valley, we're seeing homes take longer to sell than they did during the frenzy a few years ago. We're also seeing fewer homes selling above asking price. So if I'm a buyer today, does that mean I potentially have something very valuable, leverage?
Exactly. And leverage can come in several different forms. Maybe the seller is willing to negotiate the price. Maybe they're willing to contribute toward the buyer's closing costs. Maybe we can structure seller concessions to help buy down the interest rate. There can also be situations where a temporary rate buy down makes sense. The important point is that buyers shouldn't just look at the advertised rate and decide whether the market is good or bad. We need to look at the entire financial picture.
Let's explain that because rate buy down is one of those mortgage terms people hear but may not completely understand. Suppose I find a house I really like. The seller has had it on the market for a while and is motivated. Instead of saying, give me another $15,000 or $20,000 off the price, could I potentially ask the seller to use some of that money toward reducing my financing costs?
Potentially, yes. And this is where having the right strategy becomes important. Depending on the loan program and the transaction, seller concessions can sometimes be applied toward allowable closing costs or toward reducing the buyer's interest rate. There are different approaches. One is a permanent buy down, where discount points are used to reduce the interest rate for the life of the loan. Another possibility is a temporary buy down, where the payment is reduced during the first year or first few years of the mortgage. There are rules and limitations, of course, and every situation is different. But that's why we run the numbers. Sometimes the best use of a seller concession isn't necessarily reducing the purchase price.
Let me push back on you. Suppose I'm watching this and thinking, Jeff and Art, that all sounds great, but if rates drop by a full percentage point next year, I'm still better off waiting. Are they?
Not necessarily. And I want to be careful here because nobody knows exactly what rates will do. But let's imagine rates do fall significantly. What happens if that brings thousands of buyers back into the market? Now, the home you're looking at today with one or two interested buyers could have multiple offers. The seller who might negotiate today may not negotiate later. And if home prices rise, part of the savings you expected from the lower rate may disappear. That doesn't mean buy something simply because you're afraid prices are going up. It means run both scenarios before making the decision.
So instead of trying to predict the future, you're saying, let's compare the opportunity available today against what would actually have to happen tomorrow for waiting to be better.
Exactly. That's a much better conversation. Let's look at your purchase price, your down payment, the estimated payment, taxes, insurance, HOA dues, if applicable, seller concessions, closing costs. And then let's look at different interest rate scenarios. Once you see those numbers together, the decision becomes much clearer.
Let's use a hypothetical. Say somebody is looking at a $700,000 house here in the valley. The property has been sitting on the market. The seller is getting nervous. Maybe there's room to negotiate the price. Maybe there's room for concessions. Compare that with waiting 6 months, rates drop, and suddenly 5 buyers want that same type of property. What are you looking at?
I'm looking at much more than the interest rate. If the seller today is willing to reduce the price or give a meaningful concession, we want to quantify what that's worth. Then we compare that with the potential payment savings from a lower rate later. And we also have to consider what happens if the home price increases or if you have to offer closer to full price later. That's why I tell buyers, don't make a $600,000 or $700,000 decision based on one number you saw on television or online. Let's actually calculate it.
Art, you've been doing this for more than 40 years. You've seen high-rate environments, low-rate environments, booms, recessions, housing shortages, housing surpluses. What have all those years taught you about people trying to perfectly time the housing market?
Usually, trying to perfectly time any market is extremely difficult. What I've learned is that the right time to buy has much more to do with the individual buyer than it does with a headline. Are you financially prepared? Is your income stable? Do you have the right reserves? Are you comfortable with the payment? Are you planning to stay in the home long enough for the purchase to make sense? And is there an opportunity in the market that works for you? If those things line up, then we can talk about how to structure the financing intelligently. I'd rather help someone make a good decision based on their real circumstances than tell them, everybody should buy now, or everybody should wait. Neither one of those statements is true.
And I think that's an important distinction. Because the point of today's conversation isn't that everyone watching should rush out and buy a house. It's that people shouldn't automatically assume waiting for lower rates guarantees them a better deal.
Exactly. The best question may not be, when are mortgage rates going to come down? The better question might be, what opportunities are available to me right now and what would the numbers actually look like? That's something we can answer.
Before we wrap up, let me give you one last scenario. Someone is watching from the Coachella Valley or anywhere in the state of California. They've been thinking about buying, but they've stayed on the sidelines because of interest rates. What would you tell them to do first?
I would tell them to get the facts before making the decision. Let's find out exactly what you qualify for. Let's look at realistic payments. Let's discuss different financing options. And if you've identified a property, let's look at how seller concessions or other strategies might affect the transaction. You may run the numbers and decide waiting is the right choice. Or you may discover that the opportunity available today is better than you thought. But either way, you're making an informed decision instead of guessing.
That's the takeaway. Don't ask only, what's the mortgage rate? Ask, what's the entire deal? Because the best housing opportunity may not necessarily come when interest rates are at their lowest. It may come when you have the greatest ability to negotiate. Art Alvarez, MortgageWorks. More than 40 years of experience helping people make sense of exactly these kinds of decisions. Art, thanks for joining me.
Thanks, Jeff. Always a pleasure.
And if you're thinking about buying a home, moving up, or simply trying to decide whether waiting makes sense, talk with Art before you make the decision. Have him run the numbers for your specific situation. Because sometimes the most expensive decision isn't buying at the wrong time. It's waiting for the perfect market that may never actually arrive. We'll see you next time on Mortgage Minute.